In the early years of the internet, investing felt like a digital Wild West. In the early 1990s, the internet was transforming from a closed network used by academics and government institutions into a commercial platform. But very few people truly understood what this transformation would mean. Most traditional investors didn't even know what the World Wide Web was. In this environment of uncertainty, the first bold moves came from visionary angel investors and venture capital firms. Companies like Netscape became the first gateways to the future of the internet. In 1995, Netscape's IPO changed everything. The company wasn't profitable, yet its stock skyrocketed. The market received a clear message: profit doesn't matter. Growth and user numbers do. This is when FOMO, the fear of missing out, moved to the center of investor psychology. Simply adding .com to a company's name was enough to multiply its valuation overnight. Low interest rates only fueled the frenzy. And this was exactly the environment in which Pets.com was born. By the late 1990s, Pets.com looked like a perfect story. The pet industry was worth billions of dollars, constantly growing, and built on loyal customers. The pitch was simple, yet powerful. Why should people go to a store and carry heavy bags of pet food, when they can order everything online? That single question created a digital goldmine in investors' minds. Hummer Winblad, one of Amazon's early investors, and Amazon itself invested millions of dollars into the company. The message was clear: Pets.com would become the Amazon of the pet industry. Then came the marketing frenzy. Funded entirely by investor capital, Pets.com launched one of the most aggressive marketing campaigns in history. Its mascot, the famous sock puppet, became a pop culture icon almost overnight. The company ran $1.2 million Super Bowl ads. The mascot even appeared in the Macy's Thanksgiving Day Parade. Brand awareness exploded, but behind the scenes, a silent disaster was unfolding. The company was spending more money to acquire each customer than it could ever recover, even if that customer bought products for a lifetime. This is where the real problem emerged: operational math. Pets.com's business model carried one of the biggest red flags for investors: a negative gross margin. To attract customers, the company sold products below cost and offered free shipping. Pet food was heavy, expensive to ship, and had low profit margins. The math was brutal. Pets.com bought pet food for $10, sold it for $7, and paid $5 for shipping. Every single sale meant an $8 loss. Between 1998 and 2000, companies like this reached their peak. Investors poured money into everything. Massive advertising budgets, luxury offices, and dreams of rapid growth dominated the market. But in March 2000, the Nasdaq peaked, and the bubble burst. Suddenly, investors started asking a simple question: are these companies actually making money? Pets.com went public in February 2000 at $11 per share and raised $82 million. But within months, reality set in. Advertising costs and operational losses drained the company's cash. By November 2000, the stock had fallen to 19 cents. Just 9 months after its IPO, Pets.com shut down. More than $300 million of investor capital vanished. The dot-com bubble left behind a painful lesson. No matter how revolutionary the technology is, basic economic rules still apply. Brand awareness is not cash flow. Logistics remain real, even in a digital world. And if your unit economics are broken, growth won't save you. It will only make you fail faster. The internet bubble may have been a misallocation of capital, but it was also the unavoidable price paid to build the digital world we live in today.